My name is Andy Flury. I'm the founder and CEO at Wyden, previously known as AlgoTrader. We are the leading provider for digital asset trading technology for financial institutions. Since I was here last year, a lot has happened. Not only did we change our name, but there has certainly been a lot of disruptions in our industry. Today I will be talking about two things: the closing down of Signature and Silvergate Bank and what impact this has on our industry, especially for fiat on-ramps. And then I will talk about the different business models banks can select when entering or starting to offer digital assets to their clients. So the last 12 months, they have definitely been challenging for our industries. Here are just a few headlines we have witnessed over the last few months. It's definitely been a mess in the industry. We have witnessed the collapse of Terra Luna, bringing down 3 arrows. Then we had Celsius go down, the blow-up of FTX, and just a few weeks ago, Silvergate and Signature. So a lot of, unfortunately, negative impact on the market. Quite frankly, a lot of very poor risk management in the industry. I think with FTX, we all learned kind of how these big crypto exchanges work. They offer a lot of functions like trading and custody and brokerage and lending and borrowing and capital introductions and prop trading. All of this without proper governance. In traditional banking, this is different, right? All these functions are carried out by different departments within the bank, all with Chinese walls in between. So despite all of this, the commitment to digital asset is sustainable, although a little bit on a lower level than before. We've seen quite a recovery in the past few weeks essentially since the FTX collapse. Crypto market cap is up 40%. Trading volume is back to where it was before the FTX blow-up, and Bitcoin price is up 65%. So that's good news. I don't know, a few of you who have been here last year might remember I spoke about the 6 institutional digital asset challenges and how to solve them when engaging with this new asset class. Now, 1 year later, the industry really got a fast-track lesson on risk management, and 2 of these challenges materialized for many firms in our industry. So today I'd like to reiterate on those 2. The first one is counterparty risk. Relying on one major counterparty, no matter how attractive, is not a good idea. FTX told many participants in our industry the hard way what can happen if you trust just a single venue with all of your assets. Counterparty risk can be mitigated first by performing proper due diligence on your counterparties. That's a no-brainer. Dealing with multiple counterparties at the same time, that's crucial. But then it's also things like if you're dealing with a broker, you need to ask things like who sends first when we're settling, and what happens if one of the downstream exchanges goes down that the broker is using. Does the broker cover for the loss, or will you? So dealing with a multitude of counterparties, however, also brings some challenges with it and complexity. We all know that if you're trading crypto exchanges, you have to pre-fund exchange accounts and you lose custody to your funds, not your keys, not your coins, as we all know. So the amount of working capital that you need increases with every additional exchange and broker that you trade, and that increases your cost of liquidity. And this actually leads me to the next challenge, which is smart cash or smart liquidity management. Generally, you want to minimize the amount of assets you keep on exchange accounts. And there's basically two ways to do that. The first one is you need to fully automate the liquidity management with predefined thresholds. Second one is to use a centralized liquidity pool to instantly pre-fund the exchange account just in time. With Silvergate and Signature, we actually had a great option for this. Both offered instant USD transfers, but they're gone. So what are the consequences now that these two players are gone? What are potential alternatives? My hypothesis is that in the short term, dollar-denominated stablecoins like USDC and Tether will increase, but those aren't really instant. If you do an Ethereum-based transfer, that takes minutes to confirm until the deposit arrives on the exchange. By this time, the market might already have moved against you. Besides, on the day that Silicon Valley tanked, we noticed also the vulnerabilities of stablecoins. That night, USDC depegged, and it fell to below 87 cents. Now, as I mentioned, both Silvergate and Signature, they offered their Signet and Zen offering for instant USD transfers. My assumption is that we will see some copycats. BCB Group in UK, for example, they have their Blink offering, which provides sort of a similar service. They support 6 currencies, including the euro, the Swiss franc, and the British pound. And they apparently will also introduce USD shortly. Same as Silvergate and Signature, Blink-to-Blink transfers are instant, but transfers in and out of the Blink network, they take longer, and over the weekend, that's not possible at all. Then we have SEPA Instant. SEPA Instant support instant euro payments up to 100,000 euros, takes maximum 10 seconds. Problem is, not many banks support it. Will the euro one day step in and become the leading currency in the crypto industry? I'm skeptical. Then we have FedNow. That's the new offering from the Federal Reserves to launch in Q2 of this year. This will also allow instant transfers. Whether this will solve the challenges of our industry, we don't know. We'll have to see after FedNow launches. Then we have off-exchange settlement. These aren't really replacements for Signet and Zen. I believe 2023 will be the year of off-exchange settlement solutions like Copper, Clearloop, and Fireblocks. These systems allow you to instantly allocate funds to exchange accounts just before the trade. And then, last but not least, we're left with traditional payment rails like ACH and SWIFT. But let's be honest, those aren't real alternatives. They're too slow, too expensive, so not really a solution. Time will tell which of these solutions will prevail in the market, or if some completely new method will pop up. We'll see over the next coming months. Now, given what we learned about counterparty risk management, smart liquidity and cash management is becoming a must for institutional participants. To overcome this, you basically have to automate your cash management process with automated pre-funding, automated rebalancing, automated settlement. Here is an example of a simplified process that depends basically on 3 parameters per asset, and venue. It's a target exposure, a nominal exposure, minimum exposure, and maximum exposure. So if at any time your balance on a venue falls below the minimum, the system will automatically issue a transfer from your custody to the venue. If you reach the the maximum exposure, assets will be taken back into custody, and then typically once a day, the system initiates a settlement process that brings all your asset balances again to the nominal target exposure. Now, this is obviously a very simplified process. At Wyden, we've built quite a few more dynamic cash management processes. For example, you want to leave more assets on venues during trading day, less overnight, less over the weekend, or you can include volatility. If markets are volatile, you might want to have more on the venues. Now, this is one process institutions need to manage, but there are many, many more of these processes that institutions need to define and implement and ideally fully automate. And this is exactly where Wyden digital asset banking solution comes into play and tries to assist. Let me give you a quick overview. This slide here shows the key components every bank needs when launching a digital asset offering. In addition to the core banking system the bank already has on the left-hand side, they need an institutional-grade custody solution to safeguard private keys. Here we work with the largest custodians and custody tech providers like Fireblocks, Metaco, Copper, and so forth. Then obviously the bank needs an order and execution management system to connect to trading venues and execute orders. This is one of the components we provide at Wyden. And then finally, the bank needs an orchestration layer. So there are a lot of processes here in the middle. Risk management, we talked about pre-funding, warehousing, managing of spreads and fees, reconciliation. All of these processes need to be automated, and you need a platform to do this. Wyden is currently the only solution on the market that is fully capable of automating all of these functions. Wyden is battle-proofed. We have 10+ banks across Europe, North and South America, APAC that are currently using the digital asset banking solution. Now, with these capabilities at hand, a bank needs to define the digital asset trading setup that is suitable for them. According to our experience, this decision is influenced by a lot of factors. I listed a few here on this slide. I'd like to elaborate on two of them. Risk appetite. Trading against the own bank's inventory, principal trading, is an interesting offering. It's tempting due to the additional revenue stream, but it exposes the bank to the volatility in the market, and it decreases capital requirements, right? Target client segment. What is the trading flow you are expecting? Is it a high number of retail clients with smaller orders? Is it a few institutional clients with large orders expecting high standards when it comes to quality? A thorough evaluation of all these potential factors is inevitable, as the right choice of the setup is decisive for the success of your offering. From our experience with the 10+ banks we're currently serving, there are mainly three high-level directions or business models a bank can choose from. It's agency trading, principal trading, and secondary marketplaces. I'd like to talk about these and share a little bit our experiences from the projects we have done in the past. Let's start with agency trading. That's the most trivial of all business cases. It's simply to implement, but it also has the smallest profit potential. Client orders are passed directly through to liquidity venues, and as these are basically executed back to back, the bank typically trades with brokers and not so much with exchanges. As I mentioned, the profit potential is somewhat limited. It mainly stems from spread markups and fees. But again, it's a convenient solution, easy to implement, and it's a good way to get started with a digital asset offering. It's an optimal solution for a bank with a lower risk appetite, limited capital reserves. So this option, I'd say, is ideal for banks with a few large clients. Then we have principal brokerage. Client orders are here against the bank's inventory and are then hedged on the market. As these hedging orders are executed independent of client trading, brokers or exchanges can be used by this model. This model provides an additional profit potential, as only a fraction of the flow will actually go to downstream venues, meaning that the bank gets to keep most of the spread offered to their clients. Obviously, this model requires a bit of trading know-how, and it bears an elevated risk. Banks also need larger capital reserves due to inventory. So I'd say this one is ideal for a bank with retail clients, a large number, I'd say, tens of clients, typically large number of orders, but small orders in general. So then we come to the third option, secondary marketplace. We've heard a lot about tokenization, issuance of tokenized securities. Moritz Schild just mentioned in the previous panel that tokenized securities will really only take off when they become tradable on secondary markets. But this is an excellent opportunity for a bank. There are mainly two options for this: an exchange, OTF or MTF, to facilitate trading of tokenized securities. Orders from clients are executed against each other. The bank may act as a market maker. The second option, this is actually an interesting one, is an internal marketplace for cryptocurrencies. This is, for example, what Swissquote offered in Geneva. Again, client orders are executed against each other. Bank again acts as a market maker, hedging himself on downstream exchanges. This option is ideal for jurisdictions where banks cannot offer brokerage, like in Singapore and Turkey, for example. All three models are options we support today at Wyden. At Wyden, we have been assisting institutional trading firms for over 8 years. We currently serve over 10 banks implementing their digital asset offering. In total, our product has been deployed over 120 times on-premise or through our SaaS offering. Good. This was it for me for today. Hope I was able to shed some light on digital asset trading and the challenges banks face when venturing in this new asset class. We're looking forward to partnering with you in your digital asset journey. Thank you.